Good afternoon, everyone in Europe, and good morning to those in the US and beyond. I'm Rob Murphy, Head of Investment Companies at Edison Investment Research, and I'd like to welcome everybody to this webinar, which is looking at growth strategies at a value price, the venture opportunity. As we're all aware, the rapid turnaround in central bank monetary policy over the last year or so has led to a fairly dramatic derating in growth companies, and in particular in the higher growth companies at the venture end of the market. And so as a result, investment companies in those areas are now trading at very large discounts to net asset value. So I think this is an opportune time to have a review of what's going on in in the sector. And so I'm delighted to have on this webinar, we've got three very focused venture type investors in three quite different areas. We've got in alternative energy, healthcare, and space infrastructure. All trading at quite large discounts with high growth strategies in markets that I think we'll all agree have a very strong long-term future. So with that, I'll move ahead. So the basic format today will be very short 5-minute presentations. The first one will be from Wendy Huang, who's Senior Business Development Manager, our Primary Markets Americas at the London Stock Exchange, and they are co-sponsoring this webinar, so great to have them on board. We'll then move to Richard Holt, Managing Partner of Hydrogen One, then on to Woody Stileman, Managing Director, Business Development at RTW Venture Fund, and finally Mark Boggett, CEO of Seraphim Space. So welcome all participants, great to have everybody on. So without further ado, we move on to Wendy, who's going to just do a quick review of how far London's come in terms of listing these kind of alternative and dynamic growth businesses. Over to you, Wendy.
Thanks, Rob, and thank you to all the viewers who are joining us today. So as Rob mentioned, I work for the Primary Markets team at London Stock Exchange. I'm based in the New York City office, and my role is essentially to help companies and also investment funds on listing and raising capital in London. So I really just want to give a brief overview of the investment funds market in London, because for some of the investors, potentially other alternative fund managers, and maybe even some advisors who are joining us today, they might not be familiar with this asset class. I'll keep my comments very brief, as I know that everyone's probably excited to hear from our fantastic panelists. I think London offers a unique opportunity both for the investors and also alternative fund managers. So on the investor side is really to access these esoteric funds with a relatively low correlation to the wider equity market. That's managed by quality managers with a long, successful track record and also expertise in their specific strategies. And London also offers an opportunity for alternative managers to gain access to a pool of permanent or evergreen source of capital from a high quality investor base to invest and deploy in long-term growth assets. So if we could just move on to the next slide, please. Firstly, I just wanted to highlight the structure of the investment funds that are listed on London Stock Exchange, which have a closed-end fund structure. So what that means is essentially an externally managed vehicle that has a fixed number of shares in issuance at any given time, and with an independent board as well. So investors would get liquidity in these funds by trading the shares on the exchange. And that means managers don't have to worry about redemptions, cash drag, or approaching the end of life of a fund. And the manager is also able to charge fees, which can consist of a management and performance fee, depending on the type of fund. Next slide, please. Now, closed-end funds have actually existed in London for over 150 years, with the world's first collective investment vehicle called F&C Investment Trust, launched in 1868 and still listed in London today. And they've actually paid a dividend every year since existence. And now there are currently over 400 investment funds listed in London with an aggregate market cap of over $280 billion. Now, since the start of 2014, over $34 billion have been raised in London through IPOs, through fund IPOs. And many of these new fund launches in the last few years have actually shifted to the alternative side than the listed equity side. As you can see on the chart on the left, alternative funds now make up over 45% of London's fund market. And this consists of private equity, real estate, renewable energy infrastructure, other infrastructure, debt and direct lending, and also growth capital funds. And actually VC funds have been a relatively up and coming asset class on our funds market. We even have two funds, I think it's probably included in the other portion of the pie, that are invested in music royalty assets listed on our market. Now, if you take a look at the US closed-end fund market, you will see that actually the funds listed in the US are more vanilla in nature. So it'll be things like equity funds, debt funds, and municipal bond funds. But in London, investors can actually gain exposure to these unique asset classes that they wouldn't be able to easily access otherwise. So I think that's the opportunity here. In the US, you will also see usually very well-established managers come to market with very large IPO sizes as well. But London listed funds can actually cater to smaller IPOs and also a wider range of managers. Can we move on to the next slide, please? Now, London's fund market is constantly evolving, as you can see here, and we're constantly seeing new niche managers come to launch. So investors can increasingly access new asset classes via this liquid traded vehicle. But here are some milestones we've seen in the last 5 years or so, including the world's first listed energy storage fund by Gore Street Energy Storage. We've seen the first music royalty fund by Hypnosis, first digital infrastructure fund listed by Montreal-based Coordinate Capital, world's first listed space tech fund, Seraphine Space, world's first listed clean hydrogen fund, Hydrogen One, and the first EM sustainable energy infrastructure fund, Thomas Lloyd Energy Impact Trust, just to name a few. Next slide, please. Finally, I just want to highlight a few key benefits of a London fund listing for alternative managers. So I've already explained how a listed fund is essentially a permanent or evergreen source of capital. There's also the ability to scale up and grow the fund via further issuances as well. So for example, Biopharma Credit, which is managed by New York City-based Pharmacon Advisors, and also the first life sciences debt fund to be listed on our market, raised $760 million during IPO in March 2017, and has since returned to market over 3 occasions, raising additional over $600 million. Montreal-based Coordinate Digital Infrastructure Trust raised $514 million at IPO in February 2021, came to market actually just 4 months post-IPO to raise an additional $260 million, and again a year after that to raise another $250 million. And in total, they've raised over $1 billion in London already. Now, relative to the US regulations for listed funds, the regulatory structure in London offers more flexibility on diversification, leverage, liquidity, fees, and more. The investor base for our listed funds are also predominantly institutional, and there's a well-established institutional investor base in London that is actually familiar with and invests in these funds. And actually recently there's been an increasing participation of retail investors as well. There's also the ability to do testing the waters very early on in the process to gather feedback, engage appetite from institutional investors. And I think that's a very big advantage of listing on the London market. This essentially allows alternative managers to really de-risk the process. So if you speak with investors early on in the process, the appetite is strong, you can move forward. If it's not, you can pull the plug and you would have spent relatively little time and money on the process. Should you wish to proceed, there's a strong ecosystem of advisors that will help support you throughout the process and also life after listing. There's also the possibility for funds to access passive investors by listing on the premium segment of the main market as well. So I'll stop here because I'm super excited to hear from our esteemed panelists. So, for any alternative fund managers who would like to explore more about launching a fund in London, please feel free to reach out to me afterwards. I will now pass on to Richard from Hydrogen One to introduce his fund. Thank you.
Thanks, everybody. First slide, please. So good afternoon. My name is Richard Holf. I'm one of the managing partners of Hydrogen One Capital. I'd just like to give you a 5-minute introduction to the fund and then hopefully take your questions later on in the afternoon. Next slide, please. Just a disclaimer, hope you can read that quickly, and then we'll get on to the meat of the presentation. Next slide, please. So really what investing into hydrogen is about is converting the industrial grey market of hydrogen, which is a $175 billion market, in the energy transition And that's really why a lot of investors might not be seeing what's going on in the hydrogen space, because a lot's going on in the industrial market. It's also about air quality, and it's about increasingly energy security. And we've got great political support with this, with the UK doubling its UK hydrogen target, 4 times increase in EU targets, and the IRA Act in the US that people may have heard about. So it's a great sector to be working in. Next slide, please. So what's actually in the fund? We've listed out the individual positions. These are companies that make the engineering, the equipment that go into the hydrogen sector. They make electrolyzers, they make fuel cells. They're mostly in the supply chain, making that sort of equipment, followed by people making thermal plasma, electrolysis, and storage and distribution of hydrogen, as well as a very fast-growing part of the sector, which is green hydrogen production, and we're investing into those companies as well. So you can see the list of companies on the right-hand side there. This is mostly a private equity fund. These are private positions, and the growth comes from these companies where we invest into a pound or a dollar or a euro into these businesses, and we exit through the sale of these companies in 2 or 3 years' time. So that's really where the growth comes from in this sector. So that's just a snapshot of what's in the fund. Next slide, please. Let's make some comments on the valuation process. Listed funds have come under a lot of security from investors regarding the valuation of invested private portfolios. We apply a consistent approach to portfolio valuation centered on discounted cash flows using IPEV guidelines. The valuation of the entire private portfolio is reviewed and approved by the board on a quarterly basis and reviewed by the company's auditor, KPMG, annually. The private portfolio is valued using either DCF method or a combination of DCF and price of recent investment. The DCF valuation is also benchmarked against listed peer group companies. The portfolio average discount rate, for example, in 2022 was 12.9%. So these are quite conservative valuations for giving these businesses, but that's the process, and that's how we do it. Next slide, please. As we're here today, we're talking about growing value. So what's happened about reflecting that valuation case into the assets? This slide shows that the NAV movements in 2022 versus 2021 on a price per share basis on the left-hand side. The bottom line, it was a 1.6% increase to 97.3 pence per share. Compare that to the current share price. This is an audited valuation process. We saw improved valuations in multiple private positions, totaling around 6.7 pence per share, or 8% to the end of 2022, offsetting a weaker pricing in the very small number of listed hydrogen companies that we have. And on a longer-term basis, on the right-hand side, our NAV per share has been steadily rising since mid-2021 when we did our IPO, despite the market volatility that's around us. So that's a sort of an overview of value in the fund and where we are. Perhaps we'll just close out quickly by showing you an example of one of the companies in the fund, Sunfire. Next slide, please. Sunfire has delivered a 10 times revenue multiple since we invested a year and a half ago. Fairly modest, a modest valuation upgrade in the bottom right-hand corner there, as this company, like the other companies in the fund, is in the investment phase, building factories. Sunfire has got over 500 staff. It's got 2 or 3 factories. We're investing into the industrial growth of this business. We're not the only people doing this. We've got some decent co-investors. We've been joined by Copenhagen Investment Partners and Amazon in 2022. Sunfire is a well-established business. It's making grid-scale electrolyzers for customers like RWE and Uniper, and it really focuses on the alkaline and solid oxide technology that is a key part of the hydrogen industry. So that's just an example of materiality that's driving value growth in Hydrogen One Capital. And I'll leave it there and look forward to your questions. Thank you very much.
Great, thanks, Richard. So we'll move on. I'll have questions after the panelists have all done the presentation. So we'll move on now to Woody Starman from RTW. Over to you, Woody.
Thanks, Rob. And thanks very much, Edison and the London Stock Exchange, for the opportunity today. And thanks everyone for tuning in. As Rob said, I am a Managing Director of Business Development at RTW, and I'm head of our London office, which we established last year. So what are you getting when you invest in RTW Venture Fund? What you're investing in is a company that is powering breakthrough technologies and therapies that transform the lives of millions. We do this by focusing our efforts on investing in innovative biotech and medtech companies that have pathways to delivering approved medicines or medical technologies. Next slide, please. We're agnostic about where those opportunities lie, and our investment company structure gives us the flexibility and the duration to build a diversified portfolio across geographies, across clinical development stages, and company lifestyle position. The RTW Venture Fund seeks to generate a 20% compound annual return over the full investment cycle by leveraging the same philosophy and process that has generated considerable returns for our private fund investors since 2009. The RTW Venture Fund benefits from the scale and expertise of a firm that has $5.6 billion in assets under management. RTW is headquartered in New York. It is a life science investment firm that's dedicated to solving the most challenging unmet patient needs. And for those that enjoy listening to podcasts, I'd point you towards a recent podcast that our CIO did that was published just earlier this week with Ted Seides at the Capital Allocators podcast, which is really good to listen to. Next slide, please. So what is the RTW investment philosophy and process? Here it is told through our 4 pillars. Firstly, on a global reach. We now have a presence in 3 continents, and that allows us to capture investment opportunities around the world, as well as contributing to the development of biotech and medtech ecosystems in places outside of the US, which is where it is the most developed, as we endeavor to do here in the UK. We want to be as close to the science as possible. In fact, we lead with the science. So of the 80 partners and employees that work at RTW, over 20 of those have an advanced medical or scientific degree, like a PhD or an MD. And they apply their deep domain expertise to evaluate scientific assets and investment opportunities through the lens of 3 areas. One is disease area, so think oncology, cardiovascular, those sorts of things. The other parts of the investment thesis for when we assess the assets that we're looking at. Full life cycle investing. This means the ability to invest both public and private. We think that that ability is a significant competitive advantage for us over investors that only look at privates or those that only look at publics. Through access to early stage assets, we can gain an information advantage, information that is available in the public markets, but not in the public markets. Mid to late stage venture gives us access to relationships with entrepreneurs and management teams that are harder to form in the public markets. And sometimes we can formally build that influence when serving on the boards. The IPO for us is just one step towards the full value recognition of our investments. It's not an exit opportunity as it is perceived by the most venture capital funds. So we don't invest to build and sell at the nearest opportunity. We have the structure and the patience to be able to realize the value at its fullest potential. The final leg looks at our financial and transactional capabilities. So our science-led team is complemented by a team of deal makers and company operators, and their creative execution allows us to build or help build some amazing companies. And that's a win-win outcome for both our investee companies, patients, and our shareholders. So we constantly think about how best we can serve the scientists and entrepreneurs that drive that innovation. Next, please. Next slide, please. So this slide looks at all the full life cycle, multiple capital solutions offerings that we can provide to innovative biotech companies. So that includes royalty financing, geographic licensing, the ability to take a company public through one of our SPACs. And really, in the more capital constrained environment that we now exist in, this is a compelling proposition, both for the companies that we're investing in, but also for our shareholders. Next slide, please. Why are we set up like this? The reason is that despite recent market challenges, we're living in the greatest period of medical innovation in the history of mankind. This chart shows the number of new drug modalities that have emerged in recent years and have gained acceptance since 2000. And we're all very familiar, as I say, with mRNA vaccines over the last few years, but there are many more technologies that are turning into or advancing towards real drugs and cures for disease in the imminent future. Next slide, please. This is just the last slide for me. You may have recently heard of Prometheus Biosciences. About 10 days ago, it was taken over by Merck at an $11 billion valuation. And I think this is probably the best case study of what we do. We actually first invested in Prometheus in November 2019 when we co-led their crossover round, which is the round just before the IPO, at a $400 million valuation. We then anchored their IPO at around a $600 million valuation. And Prometheus is a precision medicine company that is developing treatments for IBD, irritable bowel disease. And their lead antibody program had some really quite outstanding data in Q4 of last year, which really indicated that this drug could be potentially best in class, but also there was potential for a pipeline in a product, as we call it, which is the ability to address multiple indications through their technology. But Merck obviously also noticed this. So just a couple of weeks ago, took it private for 11 billion. I think really our full life cycle approach really allowed us to develop and build that conviction in the private markets. And that conviction allowed us to hold the position at size through multiple inflection points, which you can see here. So despite a significant increase in the share price over the last 2 years, we held on to it, and it was actually a 15% position by the time it got taken out. That's what I'm going to leave it with there. No doubt we'll come back to some questions and maybe a bit more on Prometheus a bit later. But thanks very much. That's it for me.
Excellent. Thanks, Woody. And now finally over to Mark at Seraphim Space Investment Trust. You're on mute, Mark.
Thank you, Rob, and thank you for inviting me to participate today. And a hard act to follow after those two great funds, so I'm going to do my best to interest you in our fund. So I'm Mark Boggarts. I'm the CEO and one of the co-founders of Seraphim Space, and we are a specialist investor that exclusively invests in space. We're the largest, most active player in the space market globally. And let me talk to you about why space and why now. So on the slide you can see here, on the left-hand side, we're talking about launch. And talking about launch, you've always got to start with Mr. Elon Musk, who has revolutionized the rocket launch industry with his reusable rockets. So the price for sending a kilo into space has been reduced from $83,000 per kilo today to less than $1,000 per kilo. And that's really opened up space for commercialization. Now, behind SpaceX, there's a further 150 rocket launch companies you've never heard of, and all of them are vying to take down that price per kilo into space. So space is very much open for business at a price that is now game-changing and continuing to decline. At exactly the same time, there's been a revolution in the satellite industry. Satellites that you will conjure to mind when you think of a satellite, they're the size of a car, the size of a bus, and they cost hundreds of millions to billions of dollars. And what's happened in recent years is that privately financed entrepreneurs have been creating satellites of their own, but they've been using components from adjacent industries, from the smartphone industry, the oil and gas industry, the automotive industry. and they've been building satellites that are smaller, lighter, cheaper. Today's satellites are the size of a microwave or even the size of a shoebox, but incredibly, they've got much of the functionality of these satellites that cost hundreds of billions, but they only cost hundreds of thousands to millions. So if you bring these two things together, low-cost launch and low-cost miniaturized satellites, what that means is it's now possible to put up constellations of hundreds or even thousands of satellites. So that's what's going on today. What that results in is the creation of a digital infrastructure in space. So this is like the advent of a new internet, a new road system, a new railway system. It's a breakthrough in technology because these satellites are providing low-cost communications and the ability to be able to look at our Earth in high resolution at very low cost in real time. And that explosion of data sets about everything that's going on in our world and ubiquitous communications is driving some mega trends that are already underway. So trends like climate and sustainability, connectivity, mobility or autonomous mobility, IoT, smart cities, defense intelligence. So these are trends that are really being driven by this new capability from space. And they are disrupting and impacting every single vertical on planet Earth. So the real estate market, the maritime market, the oil and gas market, the logistics market, every single market you can name is able to benefit from this huge data set from space that tells them everything they need to know about how things are changing in the world. So this is $1 trillion market opportunity that we're focused upon, and we're looking to invest into a broad portfolio of the leading companies that are establishing themselves in leadership roles within this exciting market. Now, just to put this into perspective, we're still at the beginning of this huge opportunity. There's only been 17,000 satellites that have ever been launched in the history of space. There's 7,000 satellites in space today, and yet 80% of those were launched in the last 3 years. So this digital infrastructure is being built right now by the types of companies that we're investing into, and they're growing very quickly on the back of it. So that's let's just move to the next slide, which talks about where we are today. Phase one of this growth in space is around this digital infrastructure, and that's very much underway right now, and really very much the focus of the investments that we've been making in private companies through our portfolio. Looking forward by a handful of years, so a handful of years, we're talking 3-5 years at most here, there is a new phase of space. And this is really very much driven by the continued falling cost of sending anything into space. So this is the build out of heavy infrastructure in space. So these are things like data centers in space to be able to cope with this massive amount of new data sets, to crunch that data, to apply the algorithms so that what we actually send down to Earth is just the insights that have been gleaned from this data. And that leads also to other things like solar farms in space that are going to be able to provide clean energy to planet Earth. Biopharma and focus around biotech and pharmaceuticals is a development in space, because all of these experiments are done under zero-G, which really changes the outcomes and potentially leads to some game-changing results. And then manufacturing in space, indeed lifting dirty industries from planet Earth and taking them into space so we can preserve our precious planet. So this is what's happening over the next handful of years that we're just starting to look to invest into. And then if you look a little bit further out, there's a lot going on around the moon. Cislunar, the Artemis Accord contracts, there's significant money that's being invested in this area, largely by governments and NASA at the moment. And this is about building habitation on the moon. And this is really largely about demonstrating that we're capable to do that and sustainably live and operate on the moon. And then that will then allow us to then go and do the same on other further planets. So this is not an area that we're investing in at the moment. The revenues, the markets are still uncertain in this area. So we're very much focused around the phase one, the build out of this digital infrastructure, how we use these data sets really to drive terrestrial applications in existing markets. And we're just starting to look at these really exciting new heavy infrastructure projects like these solar farms in space. The next slide is my final slide, and it just really just provides a little snapshot to help you understand where our portfolio is really focused today, which is around this space to Earth, looking down at Earth, investing in in constellations that invest into a wide area of different technology areas that serve a very broad range of different markets. And you can see how we've got a limited number of investments in transportation and communication and the supply chain of the space industry. So we produce a huge amount of content around space. We've got a whole range of podcasts that you can listen to. You can listen to our portfolio CEOs talking about their incredible businesses and how they expect those businesses to scale over the course of the next few years. So our investment trust is targeted to provide also a 20% per year return over the medium term, and that's less than half of what we've previously achieved in our private funds. So I'll pause there as we go over to take your questions.
Excellent, thank you, Mark. So we're now going to do a sort of panel discussion. So I've got a sort of an outline of a few questions to start off with, but I would encourage the participants to submit questions through the chat facility there, which we will then compile and also put forward to our panelists. So great, look, really interesting snapshot of what you guys are doing. I think it really came across, the focus that you have in your segments, the potential growth there. So I suppose what the market is grappling with is, it's worried about valuations, the stocks have fallen, but then underlying, how are the companies continuing to develop? Are they developing in line with what you imagined, say, a year ago, for instance? What are the trends? What milestones have your portfolio companies achieved? So I'll pass it around. Maybe we'll start with Richard. You've touched on a couple of things, and if you give some color on what's actually happening, how sales growing or facilities being sort of expanded.
Yeah. Okay. Yeah. It's a good question. And the hydrogen sector is not immune to supply chain issues, to inflation, like every other business and development area around the world. And so we have experienced that. What goes into making these investments are typically computer chips going into programmable logic controllers, going into pumps and compressors. And yes, some of our companies have experienced difficulty in obtaining product to go into the supply chain, but it hasn't really affected the value of the business. I suppose we've had to invest a little bit more into the working capital of some of these businesses. But in terms of we sit on the boards of all the companies that we've invested into, gives us a big oversight of what's going on, and so we're sort of drip feeding a little bit of extra capital, but it's not anywhere near the sort of catastrophic levels that people seem to be predicting, based on the share prices of some of our companies. So it's all manageable. We're not immune to it, but it's just part of the growing pain of every manufactured sector in the world. So we're coping fine.
And does that apply as well? Looking at the overall market demand growth, is it today what you thought it would be a year ago, or what's the
demand for electrolyzers are the things that that make green hydrogen from water, and the demand curve has just gone exponential. It's quite different to other sectors. When we set up the fund, the demand for electrolyzers by 2030 was expected to be 40 gigawatts. 2 times 40, 80 gigawatts. It's gone up to 300 gigawatts. It's been a sort of a positive effect. Demand for hydrogen is going up and up and up.
Right. Maybe Woody, I guess you've got specific areas you're invested in. Maybe you could talk a bit about the developments that are being reached there and the sort of projections you're looking at.
The developments in our portfolio are really clinical developments or commercial developments, as a biotech company gains approval and becomes a commercial company, or M&A. Really, those are the main sort of milestones for us. On a clinical perspective, I mean, there have been plenty of positive clinical developments in our portfolio. Needless to say, it's never in a straight line. There are ups and downs along the way. From a commercial perspective, we actually, the first time we invested, a company called Immunocore, which is a UK-based oncology company. We first invested it in the Series B, actually the Series A in our private funds, but the Series B in our listed fund. That has its first approved drug as of last year called Kimtrac. So that was a big success. And then I mentioned Prometheus earlier in terms of M&A. That was the second takeout that we've had in our portfolio this year. But the portfolio as a whole, since our admission to the London Stock Exchange in October 19 to the end of March, the NAV is up about 45% in that time. That doesn't include the Prometheus uplift that I mentioned earlier. Half of that time has been in the second deepest and second longest biotech market in history. So over that time, actually, the Russell 2000 Biotech Index, which is the most comparative index for us, remember that full life cycle, so we do both public and private. About 2/3 currently is public, about 1/3 private. So the Russell 2000 is down 13% over that time. So last year we were down 11%. The Russell 2000 was down 30%. We have faced, obviously, because of that, some market challenges. And as I say, the path of innovation is never linear. But as we look at the market environment now, it's much clearer, it's clearing. And some of that innovation is now more mature and closer to either sort of later stage clinical developments or commercialization.
Right, now it's clear. And Mark, so what's going on with your companies? You've got a pretty focused portfolio there.
Yeah. Well, it was interesting to hear, the outcomes of the last year for the other two funds, because it's a very similar story for Seraphim and Space. Everything is going well. The only thing that's not going well is the price of our shares. Ukraine really changed everything last year in our sector. Geopolitical tensions have really led to governments around the world looking to use the capability that's available from commercial space. Being able to actually understand everything that's going on the ground in close to real time, in high resolution, at low cost is exactly what the world is requiring at the moment. So there is a real boom market in defence and intelligence, and the budgets are record levels, and there's an imperative to acquire the kind of solutions that we have across our portfolio. That's one side. The other side relates to climate and sustainability, which likewise is continuing to develop strongly. So across our portfolio, focused around the top 10 companies that account for 80% of NAV, their revenues are up by 56% in the second half of the year. I'm choosing the second half of the year there to sort of focus on, because that was where the sort of macro economy, really started to squeeze these companies. So we're seeing really significant growth. Now, we're obviously needed to act with some caution around this market. We've been looking after our portfolio companies, all of which, apart from one, are now funded for the next 12 months ahead into 2024. The only one that isn't has got a term sheet signed and is underway. So the companies themselves are in a robust financial position to face the year ahead. We have been making smaller investments than we have done historically to make our cash go further. So we've got 20% of NAV in cash. We've supported the portfolio, which means that we've got cash left over to continue to make new investments. And investing at the bottom of the economic cycle is really the great time to be making new investments. So we're continuing to make really good quality new investments, smaller level than we would have done previously. But this is enabling us to be able to take positions and then build our stakes in those businesses as we grow conviction, as the companies mature, and as sentiment returns to the market, and indeed our share price.
Yeah, thanks, Mark. And I suppose maybe I'll stay rather than going around sort of, in the same order all the time. But maybe I'll stay with you, Mark, because obviously the market's worried about sort of venture, and maybe you could say a little bit about structuring and what's different to me sort of buying a listed company that goes down and runs out of cash or has a problem. So what's different about the way I'm investing in those through your vehicle?
Yeah, so and it's a little bit complex, but I'm going to take you into some of the detail here, and this is around how venture investors typically structure their transactions to protect on the downside. So there are two elements that we routinely put into the structuring of all of the investments that we make, and that is preference shares and anti-dilution rights. So let me just explain what that is. So in the last reported period, we identified the top 10 holdings and how their enterprise values had changed over the 6-month period. So 4 of our companies were down by 25%. A number of companies were up, and that balanced out across the portfolio at 15% down. So the enterprise value of that part of the portfolio was down by 15%. But enterprise value doesn't equal fair value. The fair value only fell by 3%. So the reason for the difference between the fall in the enterprise value and the fall in the fair value was around how we structure our investments. And again, this isn't specialist to Seraphim. This is typical by venture investors. But let me just explain across these two methods. So one of them, preference shares. So this is when we invest into a company, our shares sit at the top of the stack in terms of the cap table. We sit behind debt, but we sit on top of all of the other equity. So let me give you a simple example to explain how this works. If we invested £50 million into a business that's worth 200 million enterprise value, that means that the new enterprise value of that business is 250 million. So in the event that the enterprise value of that business fell by 50% to 125 million, what happens to the valuation of our preference shares? Now, I've mentioned that these preference shares sit at the top of the stack. So upon a realization or indeed a valuation, the first 50 million of that 125 million valuation is returned to us. And the balancing 75 million, which is the balance from the 125 million enterprise value, is shared by the other shareholders that sit in the stack below us. So as such, our fair value of our 50 million investment is unchanged, despite the fact that that company's enterprise value has fallen by 50%. So this is a way that it reduces the downside of valuations in the market. Let me just take that one step further. So using the same example where we previously invested in 50 million and the valuation is halved, if another investor comes along and invests 50 million afterwards, so 125 million plus the new 50 million takes them to 175 million enterprise value. What's the valuation realization event for our holding? So the new investor sits above us in the pref stack. Their value is still 50 million, leaving 125 million to be shared by the other shareholders, of which we sit on top of the stack. So we get our full 50 million back, leaving 75 million to be shared by the other shareholders. So even in this circumstance where the share price is halved, another investor has come in after us and invested another 50 million, our fair value of that holding remains at 50 million. Indeed, the enterprise value of that in that scenario would need to fall below 100 million to impair our fair value. So this is one of the key measures as to why enterprise value and fair value don't move in tandem. The other thing is in relation to anti-dilution rights, which we routinely have across each investment in the portfolio. So just briefly to explain what this means. So in the event that a subsequent investment round is undertaken at a lower share price, those that have the anti-dilution rights are issued with additional shares at par in order to rebalance the holding, in order to avoid dilution. So we typically have weighted average anti-dilution, and that means we don't get 100% protection against dilution. It's typically somewhere in the region of 20 to 50%, but it's still a great protection measure. And this is particularly designed for markets like today, where prices over a short period of time are very variable, but this enables us to be able to have these downside protections. So given this, our NAV has been considerably robust, despite the fact that a whole range of the enterprise values of our underlying portfolio companies that are in many cases measured and valued against baskets of publicly available stocks, they've still been very robust from an NAV perspective.
Right. No, that's a very good explanation, Mark, and I think that applies to all our panelists. But I think maybe I can ask just maybe a slightly. I think that what you've described there is very clear and differentiates what goes on in these portfolios relative to just buying a listed stock. But Woody, just on the valuation, and I'm sure you're structuring things as well similarly. Looking at the derating we've seen, and you've had pretty big uplifts, and the last one, I mean, you talked about the valuation, but on a 15%, nearly 15% of the portfolio investment, you've been paid an additional 75% premium on top of that. And so, I guess, what do you think? Maybe you talk about the valuation process that you're using, which enables you to actually realise at such big premiums to very recently struck NAVs.
Yeah. So, like Mark, as you say, we have similar mechanisms to protect against the downside. So, about 2/3 of the venture investments that we make are mid to late stage, and we lead probably 50% of those. So, we're able to negotiate the price and establish a senior position in the cap structure. So, same as Mark on that front. In terms of our valuations, I'll come back to Prometheus in just a second. That was actually a public company that got taken out at a 75% premium. Syncor, which was the other public company that got taken out earlier this year, was taken out at a 206% premium to the prior closing price. But those were both public companies. In terms of the private market valuations, so we have an independent team of valuation experts at RTW, and they sit within the fund services team as opposed to the investment team, and they mark the portfolio to fair value on a monthly basis. They're helped by 2 third-party valuation companies using multiple approaches, discount rates, market comps, and all those sorts of things. Because our view is that there's enough surprises investing in biotech, given the binary nature of it, that we'd rather that valuations didn't add to that. So that's how we think about that. That's how we do the valuations. How that then filters through into the portfolio. If we look at our year-end 31st December 2022 portfolio, we had 25 private positions. We actually marked down 17 of those 25 over the course of the year by an average of about 23%, despite all the things that Mark said earlier about downside protection, all those sorts of things. And in the majority of those cases, it was driven by exogenous factors. In terms of those that we marked up, we marked up 7 positions. 1 remained unchanged over the period, but 5 out of the 7 were for very clear clinical development advancements or financing or transactional changes. So so that's really how we think about the valuations of our private portfolio and what we do there. We come at it. I mean, RTW is originally a public market investor. We've increasingly done more and more private equity and venture investing. So we sort of think about things on a sort of a more mark-to-market basis than maybe some venture investors. But as I say, those 2, Prometheus and Syncor, were on public investments.
Right, and Richard, on your companies, obviously they're much earlier stage here, but you have been, I guess, realizing some value through sort of corporate action and mergers within your portfolio. And has
Yeah,
that validated? Has that helped validate the valuations in there? I mean, maybe you can talk a bit about that.
I mean, I just wanted to point out, the simple fact that a lot of investors should remember, what you don't get when you buy shares or you buy an open-ended fund is a valuation statement. With investment trust, you get a valuation statement. Effectively, it's almost like the annual report telling you what the shares are worth. And in our case, it's KPMG. We have to convince KPMG what the valuation is, and that's what the NAV does. And my colleagues have already mentioned that they've also got other parties that do the same thing. So that's a very important thing about investment trusts that people don't seem to get. That it's not us saying what the company's worth. It's somebody else telling you what the shares are worth. And the companies we invest into are not early stage. I mean, the whole point is that we are buying out venture capitalists to invest into companies that have got 2 or 3 factories, 300 or 400 staff. They can demonstrate a market share, and the market share is growing. That we co-invest with people like Hyundai, Kia, Amazon, and others that are quite often involved in buying the products from these businesses. And so it's not an early stage sector either. Hydrogen has been around since the 1930s. What it's the renaissance that's going on is the modern the digital age of control systems that are making electrolyzers and fuel cells a lot more efficient. That we can actually make energy from water, from Middle Eastern oil, but by using hydrogen as a source of energy. But it's not experimental. We're not investing into companies that are just rolling out of university departments. They did that 10 years ago. These businesses are now about to be acquired by people like Siemens, Bosch, Rolls-Royce. That's where the uplift in value comes from. This style of investing. It's about the rest of industry realizing that it's got to catch up and buying out these mid-sized companies that we're investing into. So that's our approach. But the investment trust thing is key to all 3 of these funds. Don't forget these valuations are independent.
That's a good point. I guess just differentiating from public markets is the buyers ultimately are different. The person you sell your asset onto is typically going to be an industrial buyer. Ultimately, with Woody, it's the big pharma, and yours is the big industrial conglomerate. And I guess, Mark, eventually yours will be some of the aerospace businesses that you're potentially disrupting as well.
Yes, that's right. But it's as much insurance companies or the industries that we're disrupting that will buy this capabilities as well. So that the exit options are very broad.
So again, maybe the other thing to come around to is, I'm just mindful of time here. Let me just have a look at the Q&A. Where are we there? If people want to submit questions. So one of the questions has come in asking about discount rates applying to the portfolio. And I think, Richard, you already covered that off.
Yeah. 12.9%. That's what we're that's the average. It varies between company because risk-free rates vary by country to country. But we do a detailed capital asset pricing model-based calculation of discount rates, and then the KPMG pull that to pieces. So it all has to stand up.
So maybe Woody, I'll pass over to you. What are you using there?
Sort of mid-teens discount rates, but as Richard says, they're different based on different cases. But mid-teens is what we generally underwrite, right? Our valuations too.
Yeah, and Mark.
Yeah, so we don't apply discount rates in the same way that are applied elsewhere. These companies are early stage in new addressable markets, so discounting back what the future revenues and profits might be it doesn't really work. So what we do where there hasn't been an external funding round within the last 12 months is that we use we identify a basket of comparable companies. And then we will value the company based around that basket comparable. But we'll also take into account as to whether the company has hit milestones, hit its budget, where it is on that as well. And again, this is then all signed off by the board and by our independent auditors. And these numbers are very robustly evaluated.
Right. So maybe looking forward a bit. So I mean, you've talked about sort of what you're doing and some of your recent successes, but what areas are you particularly excited about? In terms of a particular subsector or a company, that you would highlight where you see particular potential. Who wants to go first?
I'll take that.
Yeah.
I think for us, the innovation that's happening in biotech and medtech is really so broad across modalities and disease areas that really you need to cover that as comprehensively as possible, which is why we have such a big team to do that. But really, so let's just take that off the table for 1 second. From a sort of investment perspective, I think there's probably two groups that we're most interested in at the moment. One is those that are strategically interesting for large cap pharma. Large cap pharma has about 300 billion of net cash on its balance sheets right now. They have the problem of significant patent cliffs coming in 2026, and they need to fill those revenues through acquisition. So this is why you're beginning to see things like the Seagen deal with Pfizer, the Prometheus deal with Merck, Syncorp, another one, Prevention Bio, wasn't one of ours, but it was taken out at a 270% premium, which was to the prior closing price, which was 130% premium to the 52-week high. So real money people coming in and paying these prices. And then the other is that outside of those assets that are strategically interesting for large cap pharma, the risk reward skew right now is incredibly attractive. And these are for companies that are developing non-blockbuster drugs that might be in early stages. But in many cases, we're looking at 10 to 15x type returns over a reasonable period of time, with not a huge amount of downside. The way that we think about downside in biotech is if this company fails its clinical trials, normally what happens is it trades to some multiple of the cash on its balance sheet, so 0.8, 0.9 times. So we know what the cash is, we can see what the downside potential is, and then we can compare that to what the upside is. And that risk reward is quite attractive right now for these development stage assets.
Very good. Mark, would you pick anything out in particular? Right?
Yeah, let me highlight our largest company. This is a business that we've got a double stake in because we're so excited about it. And I think hopefully it will sort of bring home just the sheer scale of the opportunities in some of our portfolio company. So this is a company called ISI. It's a Finnish company, and we originally invested into it in our private fund, and we then doubled down in our public growth fund. And what this company is, it's now become the largest constellation of radar satellites. So what's a radar satellite? Well, a radar allows you to be able to look down at the ground in high resolution, 20 to 50 centimeter resolution, and understand what's happening to that square meter of Earth. Now, it doesn't matter whether it's day or night. It doesn't matter what the weather is. It can go through any kind of weather, any kind of cloud, which means that you can reliably see that square meter of Earth every 3 hours currently, and they'll be moving that towards 1 hour, and then they'll be moving that on towards minutes as time goes ahead. And what they effectively do over that square meter of Earth is they then determine through algorithms the change detection. What has happened in that square meter of Earth in the last 3 hours, the last day, the last week, the last month, the last year, and then again using artificial intelligence to potentially predict what might happen going next. So you can see that this is generating a giant data set about everything that's going on planet Earth, and that data can then be used by any industry to help them understand change within their industry. So the insurance industry is an example, huge customer at the moment, massive growth. So they're using it for climate-related weather events. A flood has happened in a particular area, and what they're able to identify is the extent of the flood, which assets are flooded, the depth of the flood water, the speed of the flood water, and then the insurance company can use that data as a source of truth, and then use that to pay out against claims, reducing the costs of their claim procedure, but also getting money back into the hands of their customers quickly. And you can apply that kind of solution across every vertical. Think about looking at projects for construction around the world and being able to understand brick by brick as those projects are developing. So this is a company that's growing very, very quickly. In fact, climate, defense, intelligence are the customers that are really driving this. It's about 500 people now, a record year that the business is having. And that sort of typifies the type of businesses that we've invested into. This company uses a radar sensor modality. Other companies have different types of sensors that give them different types of superpowers to be able to understand and monitor what's going on the Earth.
We are frankly shocked by the rate of green hydrogen production going on in Europe. And we've got exposure to two companies, HH2E in Germany, which we've co-invested in with Foresight, and Gen2 Energy in Norway, with Vitol and others. These are companies that are splitting water and making green hydrogen. We're taking a final investment decision on 100 megawatt projects in both cases this year. We didn't expect to be doing that for another 2 or 3 years, just an indication of how fast things are going. We're also really excited about the merger that we announced earlier this week between Cranfield and Britten-Norman. This is to do with hydrogen flight. So propeller-based aircraft can run on electric motors. Electric motor can be run by a fuel cell. You can't put batteries in airplanes, they're too heavy to take off. This is going to be the first hydrogen-based company in the UK concentrating on the aerospace sector. So we're really excited about that.
That's great. We are slightly short of time, but I would like to get one other little thing in. I think very briefly, maybe I'll stay with you, Richard, as well. Just I think all your companies are contributing to a positive change for the planet and mankind. So I mean, just how are you measuring that and showing the positive sort of ESG benefits of investing through your fund?
Yes, I mean, it's environmental, hydrogen, zero carbon, obviously that ticks a great big box, but social and governance are very intricate areas that we're very passionate about. And so we are an Article 9 fund, which means we've achieved the highest, the ranking of investment firms that treat environmental social governance seriously. So we take that very seriously, which means we monitor everything we're doing in these companies, everything they're doing as well, in terms of not just the zero carbon, but the supply chains, making sure that there's good diversity in the boards and the businesses. And as both my colleagues will attest, when you invest into private companies, you have a lot greater insight and control to what's going on. We sit on the boards of these companies as well, so we can see that through. So that's what we like.
As I said at the start, we power breakthrough therapies that transform the lives of millions. So we think we're doing a pretty good job on that front, and that's what drives us. But up till now, we haven't probably done a great job on measuring it and demonstrating it to investors, shareholders, and so on. But something that we'll probably do more of in the future.
Sorry, Mark.
And yeah. So first of all, I'll just sort of address the elephant in the room, if I may, in relation to space. A lot of people see rockets going into space and just have an assumption that comes with just huge amounts of carbon and it's terrible for the environment. That is just not true. The launch of a Falcon 9 is not that dissimilar to a fully laden jumbo jet going from London to New York, and we know how many of those fly around the world. So in terms of ESG, we've really tried to be a sectorial leader on this in terms of driving ESG in our sector. So the companies that we're investing into are looking at the planet and gathering information. So this is helping other companies report on their ESG capabilities. So many of them currently self-reporting about how they are adding to carbon. In the future, the space companies that we're backing will be able to independently measure that, and that will actually bring a lot of confidence into the ESG ratings, so that people can make decisions on the back of that data. We're also investing into businesses that are driving sustainability. So, for example, one of our portfolio companies, AST, cell towers in space, providing the capability to connect any mobile phone without any hardware or software adjustment. Half the world on 5G, half the world on 0G. So this is a way of getting those 0G customers. And what happens to them? Well, they access health, they access education, and it changes people's lives. And then finally, the types of things that we're investing into are not just about measuring this type of thing. It's about addressing some of the world's biggest problems. So I've alluded to things like solar farms in space. There's 5 of those globally at the moment. We've focused ourselves on one of them, and in the decades to come, we see that as delivering clean energy to our Earth. So all of the companies that we invest into, we measure them against the UN Sustainability Development Goals, so that we're actually just measuring the sort of forward-looking impact, as well as closely measuring all of our own ESG variables as well.
Fantastic. Brilliant. So I'm mindful we've run over a little bit there, but I think that was an important angle of all these funds to get across. I'd like to close now and thank all our panelists, Woody, Richard and Mark, and also Wendy from the London Stock Exchange. I hope everyone has a great afternoon. If you want to find out more about these companies, please let us know. We can put you in touch with them. We can contact them directly or through Edison or through the London Stock Exchange. Have a great afternoon. Thank you.
Thanks very much, everyone.